they can actually refinance with a private lender that will release you from the co-signing responsibility, or the current loan that they have may have a co-signer release option, which you can investigate. It would require the primary borrower to submit information about their current income and credit. But if it is a strong enough profile, they could consider removing you from that loan even without a refinance. Now, when it comes to the unique features of private student loans, there are a couple. The first, and I tell people who are either trying to refinance an existing private student loan or they have federal student loans and they're considering refinancing the private lender, I tell them to check rates for private student loans at least 3 or 4 times a year. And the reason that that is so easy to do is because, unlike most forms of debt, where in order to get your interest rate, you have to have a hard pull of your credit, which negatively impacts your credit score. With private student loans, you can get a pretty good idea of what the rate would be if you formally applied to a soft pull of your credit. So that means that not only can you check interest rates frequently, but you can check with as many different lenders as you see fit, as frequently as you see fit, which is why I tell people whenever it comes to a form of debt that you're considering taking on, you want to apply with at least 3 different lenders. That is doubly true when it comes to private student loans because there is no negative credit impact when you apply with 3 lenders versus 7 lenders to see which can give you the best terms and the best interest rate. Another consideration when it comes to private student loans as compared to other forms of debt is that if you do decide to pull the trigger and submit a formal application, which would lead to a full hard credit pull, but you're getting a better fee, you're getting a better interest rate, you're getting a better repayment period, and maybe 2 or 3 years down the line, there's another scenario that pops up that is even better than your current student loan. Unlike other forms of debt, like a mortgage, where there's closing costs when you refinance a loan, with private student loans, there are no origination fees or closing costs, which means that you could conceptually refinance a private student loan 10 or 15 times. There's not going to be a negative financial consequence based on the amount that you owe because of those lack of origination fees. So if you're in the camp where this makes sense to you, that camp being you owe less than 1 times your household income in student loan balances, then these are the types of things that you need to consider. Next, let's go to camp number 2. These are people who owe between 1 and 1.5 times the household income. This is a camp that really has to make a decision based on what makes sense given the balance of their finances. Because the good thing that this camp has going for them is, at least when it comes to income-driven repayment plans, they are likely going to have a partial financial hardship. Now, the downside, however, is that if you have between 1 and 1.5 times your household income, there's also the distinct possibility that even though you have a lower payment under IDR, it's still going to pay off your loans before they're forgiven in 20 or 25 years. So by lowering the payment, you are giving yourself more flexibility in terms of your finances, but you're really just extending and paying more towards the student loans over time because of the way the interest accrues than you would by just paying it off in full under a more aggressive option. So if this is you, you really have to look at the payments through things like the calculators that we have or other ones online to figure out just exactly what is that gap between your IDR plan and a 10-year standard plan, or a plan that you would have available through a private lender, versus just leaning on that lower payment to address other areas of your finances. For example, let's say that there's not much of a gap, but let's say that you do some calculations and your payment under an IDR plan is $150 a month less than it would be under the 10-year standard plan. But because that's still not that much lower, you do some calculations and find out that you're going to pay off your loans in 16 years if you continue making that payment. Well, in that scenario, I would consider it worthwhile to look at interest rates for maybe 15-year repayment plans with a private lender that might offer a lower interest rate than what you have on your federal student loans. And you may find that you can keep at that lower interest rate a payment that's very similar to what it would be under an IDR plan and shave an entire year off of your repayment schedule while making the same payment because of the lower interest rate. Now, obviously, there's additional things to consider when it comes to leaving federal student loan umbrellas, like the flexibility that we've discussed when it comes to this debt as compared to private. But if you're within this window, this is what I'm talking about, where it is not as straightforward as just signing up for the income-driven repayment plan and forgoing all other options to the point of not even researching. And then lastly, people who owe greater than 1.5 times their household income. Because people in this camp are likely going to find that going the IDR route and aiming for forgiveness is going to save them a significant amount of money as compared to trying to pay it off in full, even with a private lender or the federal government. So if you can save $300 or $400 a month and you're going to have your loans forgiven in 20 years under pay, as an example, then it wouldn't make sense to pay that additional money to pay it in full over 20 years with the federal government, or even refinancing at a slightly lower interest rate with a private lender because of that huge gap between the payment savings under IDR. So if this is you, the strategy is to optimize the income-driven repayment plan payment that you are making. That optimization includes you choosing the right plan, making sure that you have direct loans only, because typically the most forgiving payment plans require direct loans only, and to consider public service loan forgiveness. We talked about it last night on the actual live version of this webinar, but I can tell you that when it comes to people with significant student loan debt, I think that the availability of public service loan forgiveness is often discounted. The one area where I don't see it discounted is in the healthcare space, where you see residents and fellows who really can just say, oh, well, all I have to do is do my residency, my fellowship, and then work for a nonprofit hospital or the VA for a couple more years, and I'm done. And then I can go, quote unquote, make the big bucks. But outside of medicine, I typically see people who are discounting the benefit of having student loans that you would have had to pay for 20 or 25 years forgiven after just 10 by working for a nonprofit or a government entity. So yes, you may make a decent amount more working in private industry, but if you're telling me that that additional amount requires me to pay $500, $1,000, $1,500 a month towards my student loans for 10 or 15 years longer than if I just worked for a nonprofit or a government entity for 10 years, I'll take working for the nonprofit or the government entity. And I do see this, thought process where it's like, oh, I'll only be making half. That's not always the case. In some industries, that difference between nonprofit and private is not as pronounced as it is in others. So if you told me that I could make 150 for 20 years, but I have to pay for my student loans, or I could make 100 for 10, have the student loans forgiven, and then go make 150 for the next 10, I'll take option B 10 times out of 10. So that's something to consider if you find yourself drowning in student loan debt and you're looking for a way out, a career change within the same industry, but with a different sector, public versus private, could be something that's in the cards. Optimization also includes making sure you use all the information we just shared to find the right income-driven repayment plan for you. And then also, once you have chosen your plan, understanding what helps lower your payment while also benefiting the other areas of your finances. If you're looking on screen, you're looking at a formula that shows discretionary income. Given your different payment plans, you're going to pay either 10% or 15% of discretionary income towards your loans each month. But that formula for discretionary income is adjusted gross income minus a certain percentage of your federal poverty level. Federal poverty level is a little too deep to get into on this call, so we're going to focus on reducing adjusted gross income, which reduces your discretionary income, conversely reduces your student loan payment. And there are some key ways that you can reduce your adjusted gross income that are available to any taxpayer. And those ways are what's called above the line deductions. Those are things like your pre-tax retirement contributions, be they 401k contributions, IRA, 403b, 457. If you're an entrepreneur, half of the self-employment taxes that you pay each year go to reduce your adjusted gross income. If you earn below a certain amount, the interest that you pay on student loans reduces your adjusted gross income. And if you have access to an HSA, FSA, or dependent care FSA, all of these things reduce your adjusted gross income dollar for dollar, meaning that if you have $5,000 worth of above the line deductions, it reduces your AGI by $5,000 as it does your discretionary income. And that has and can have an outsized impact on a reduced student loan payment. So if you're going to have it forgiven, you want to have it forgiven after paying the least amount possible towards the student loans. And this is one way that you can do that. So let's go into some of the questions that we had for this. One of the questions was, when exactly can I sign up for Pay As You Earn? Those applications are actually due to go live this week. In the recap email, we will put a link to the sign up page for income-driven repayment plans through studentaid.gov. If it's not working for you, then definitely in the next couple of days. But if you're looking at different announcements, those applications for both Pay As You Earn, and if for some reason you're signing up for income contingent repayment, They went live this week. Another question that we had last night had to do with having student loans and getting married and filing taxes with your spouse. So the person was asking, if I'm married and I have federal student loans, should I file my taxes apart or together with my spouse? We're not tax preparers, so I can't definitively give you that answer, but I can tell you what happens when you file separately from your spouse. First, if you file together, then your spouse's income is going to be included in your student loan payment for income-driven repayment plans. That's just what it is. So if you file your taxes filing jointly, then that person is now a part of the income calculation. If they earn a significant amount of money, then that's something that could lead to a significantly higher payment. And if they don't have federal student loans, it's something where it's at least worth considering filing separately. Because if you have a person who's making a ton of money, they don't have student loans, you're making a payment that's impacted by their income and they don't have any student loans at all. So something to consider. If you decide to file separately, the way that your taxes are impacted, which then impacts what's used to calculate your payment, depends on the state in which you live and whether that state is what's called a community property state or a common law state. I didn't have this information in front of me last night. That's the benefit, at least, of having to record this again. But the community property states are Arizona, California, Idaho, Louisiana, Nevada, New Mexico, Texas, and Washington. And those states have very unique laws when it comes to taxation. In those states, if you file your taxes separate from your spouse, instead of, like it is in all the other common law states, getting a tax return that just has what you earn. So an example would be in a common law state, if I earn $100,000, my spouse earns $200,000, we file separately, I would get a tax return that says 100,000, she would get a tax return that says 200,000. In community property states, it works differently. They put all your household income in a pot, in this case, $300,000. It doesn't matter who earns what. If you file separately, they just give you 50% of the income in the pot. So if I earned 100,000 and file separately, I'm getting a tax return in the community property state for 150,000. My spouse earned 200,000. She also is getting a tax return for 150,000. It splits it down the middle. So if this is a scenario and you are the spouse that earns the higher amount and you have student loans, that works to your favor. Because if I earn 200,000, but I have a tax return that says 150, that's what they're using to calculate my payments. This works even better if you have a stay-at-home spouse. If you earn 200,000 and your spouse didn't work at all, then now you get a tax return that says 100,000, which is really, really beneficial. However, if you're the spouse that earns 100,000 and you're getting a tax return that says 150, now you have to think about whether it makes sense, because not only is it increasing your student loan payment, but married filing separately in many cases leads to higher taxes for the taxpayer. So you definitely want to make sure that you do this in concert with a tax professional, because it is not as simple as just filing separate, taking the benefit of the payment. It could negatively impact your taxes if you're unaware of those consequences. So if you're watching this replay, I thought the webinar was very well received, but believe it or not, those are the only two questions that we had. So that's the end of the question and answer section. That's the end of this recording. I hope this information was beneficial to you. We will have this replay out to everyone who was live and also those who paid for the replay who weren't able to attend live last night. If you are listening to the podcast, and we are going to give you the option to sign up for this replay even after, because it's something that, at least until student loans change again, will be very relevant for people in the coming months. I'll talk to you soon.